In today's stock market brief show, we are going to uncover the hidden forces driving this market. There are two critical assets, the dollar, the 10-year yield, and they are quietly shaping the moves that we're seeing across markets from equities to commodities. Today, I'm going to be breaking down some of these eye-opening charts that are going to reveal how these forces are working, their correlations, and why knowing their direction is essential for predicting where other assets might go next. We'll also dive into signal charts, expected moves, current market conditions to help you stay ahead in this ever-changing environment. Let's get into today's show. All right, ladies and gentlemen, welcome back to the show. First and foremost, we got a lot going on this week. We got the start of new earnings. So we're going to be starting there Wednesday before the open. We're getting a lot of big banks to report their earnings before the open on Thursday. We got TSM, UNH, we got more banks, Bank of America, Morgan Stanley, and so forth down the list. So we got earnings kicking off for this quarter, and the market is on edge because we have some big, important macro data to come too. Now, instead of me just giving some insight and some thoughts of what I think inflation is going to come at, I can basically keep it pretty simple. I can say if it comes in hotter than expected, probably not good for the market, and hotter than expected means it's going to come above consensus. And if it comes in cooler than expected, that could be positive for the markets. But that doesn't matter. What matters is what the market's expecting as far as risk. For example, going into today's trading session, the market said, I'm expecting this amount of risk. Well, we gapped down to start the day right into that level, and it managed to hold this daily implied move, and we started bouncing from those levels. We'll go over the new expected moves today. And we'll also retouch up on now the new weekly implied moves and give some more details around that. Now, if you don't know this, I have a Patreon that syncs to Discord. It's $9 a month, or you can pay annually. And I'm bringing this up now, not to necessarily promote it, but to show you some of the stuff within there. And one of those tools that I like to use is known as the daily zones. And that's this right here. It's actually a quite extensive document that includes all the numbers and the breakdowns, but I like to look at a fractal view of the market. And I'm bringing this up now, and I have in the past. It's basically showing the indicator itself. The indicator is known as bridge bands. And I'm just extracting the data and turning it into more of a visual representation across multiple assets, whether that be the S&P 100, the entire S&P 100 I do, currencies, commodities, volatility, you name it. It's an extensive list. China, crypto, all kinds of stuff. But I'm showing you this part of it because things are getting a little frothy. And by frothy, I mean the two assets that are important to watch, and that is the dollar and the 10-year yield. These intermarket assets, like I've said earlier, are really quietly shaping moves that we're seeing across markets. And I'm going to show you some very eye-opening charts, because if you can determine where the 10-year yield is going to go and where the dollar is going to go, and you understand the correlations of where they are now, it can give you a massive edge in these markets. So I wanted to show you the other times that we've seen the dollar and the 10-year yield reach up north to their upper bands. Now, you'll see some colors on this chart. You might not understand it yet. That's totally fine. The red lines basically tells you whether it's in a positive trend or a negative trend. And so the S&P 500 just recently went into a negative trend or a bearish trend. The dollar is in a bullish trend. The 10-year yield is in a bullish trend. No surprise there. And when they reach up into their higher ends of these bands, you can typically see some consolidations and or pullbacks. Let me show you. This is the 10-year yield. Now, I'm highlighting all the way to this day. Now, this day is when this little bar right here turned from red to green. So the 10-year yield went into a bullish trend right here. And when we started breaking out into a bullish trend, see these little lines right there? That's just indicating that that's when we were reaching the higher level of the specific band, like doing so like this. Maybe it was a little bit less, okay, but it was right in that upper range within the top 10 percentile there. Okay, so as you can see, what happened? Well, we started getting frothy and we consolidated before running up. And then we started to get a little frothy again with some, kind of bundles here. And what happened? We started getting a little frothy. We consolidated and pulled back down. Then more recently, right over here, we pulled in, we pulled back, we consolidated from reaching these levels. Now, I'm bringing this up now because we are once again, 2 days now, reaching to the higher end of these levels, which typically indicate a period of consolidation or somewhat of a pullback that we've seen in the past. And as we're reaching up here, right, we're not crazy far away from 5%. It doesn't mean it can't go higher, or we can start clustering like we've seen in the past. But after an extensive move, things are getting a little frothy here, and that's why I'm calling that out right now in the short term. The dollar, very similarly, okay, right over here is it went from a bearish trend, and this day right there put us into a bullish trend in the dollar. And you can see we started moving up, consolidating. We started getting, after breaking out of this consolidation, we started getting some frothy signals over here, and we went through a period of consolidation. We saw a nice spike here that brought us into some of the overbought conditions there. We consolidated, we broke out, another little frothy signal, we consolidated, pulled back, and now we're doing the same thing, and we're pulling into seeing some clusters here of being extended, little frothy on the readings of the dollar. And as you can see here, when these are going up, what do you see towards the bottom? Well, you see S&P 500 down there. Obviously, you see TLT because those work. Obviously, the correlation there is negative. And if I just show you this chart, this will give you, I've showed this chart multiple times where you see a rising dollar, rising 10-year yield, and you typically see the S&P 500, fall flat, falls on its face a little bit, consolidates. You can see the same thing here when the on the flip side of it, you can see the same thing here. When the dollar was dropping and the 10-year yield was dropping, what was the S&P 500 doing? It was ripping higher from this prior low to this high over here. So this is incredibly important. Why? Because if we know that there's going to be a potential turn in the dollar or the turn in the 10-year yield, this can set us up for a big edge coming into the shorter term and potentially even a trend change, but it's just not there yet. Now, I want to show you something that I think is really eye-opening. And this is looking at 20-day correlations amongst multiple assets to the dollar. Okay, so here's the dollar rose, and now down here is a bunch of different assets. Okay, so here's the S&P 500. We just showed that right over here, right? But what's the correlation? It's minus 0.8. It's negative, which means what? It means that when dollar goes up, S&P 500, the correlation on the 20-day rolling correlation, it's pretty negative, pretty deeply negative, and that means they move in an opposite direction. Okay, look at the NASDAQ 100. That's getting a 0.82, so even a deeper negative correlation. The IWM is 0.83, the deeper correlated asset to the dollar. Look at EEM. Now, what is EEM? That is emerging markets. Okay, so emerging markets, deep negative correlation to the dollar. Actually, it's a very deep, it's 0.92. Now, why could that be? Well, China equities, there's about, I think the weighting when EEM is near 20%, maybe even more. I'd have to double check now, but that could be one of the reasons here. The dollar goes up, it can hurt emerging markets. Take a look at Bitcoin's 20-day correlation, minus 6.7. So it's a negative correlation, not as strong as some of these other assets from a negative standpoint, but still, you can see it was once positive, and then now we're slipping into a negative correlated state, meaning if the dollar comes off, could be positive for Bitcoin. Look at KWEB. This is specifically China, minus 7.3 correlation. So China equities there, negative correlation. Housing index is a minus 0.85, big, strong negative correlation there. So what does this tell you? Right now, in this moment, if the dollar starts turning, you can start to see potential moves in some of these assets that have a deep negative correlation, like, small caps, like some emerging markets here. They can see some potential relief, like the housing index potentially. But let's take it a step further. Instead of just looking at the dollar's correlation to these assets, what does the 10-year yield also look like to these assets? And you can see here, as the 10-year yield has been rising, what is the correlation to these assets showing? Well, the 20-day correlation to the S&P 500 is a minus 0.69. You have a minus 0.7 on the NASDAQ. You have a 0.84 on the IWM, so small caps. So a rising dollar right now, in this current environment, a rising dollar and a rising yields smoke small caps. That is what's smoking small caps right now. So one could assume that if we know and we can find the turn and spot the turn or the change within the dollar and the 10-year yields, and this correlation holds to be negative, you can see some positive benefits in stuff like small caps. And it doesn't have to be the IWM. It could be some individual names that are already showing strength. Emerging markets, 0.86, deep correlation there. Bitcoin, 0.67. KWeb, China, right? Minus 0.7. And then the housing index is minus 0.88. So a huge deep reading there. And why could that potentially be? Why would a rising yields hurt the housing index? Well, the 10-year yield has a strong correlation to mortgage rates, the 30-year mortgage rates, right? There's typically a very strong correlation between those assets. And if rates are going up, well, that can put pressure on the housing index. And matter of fact, let's just show you the housing index right here. HGX has been seeing some significant weakness. And if you just look down here at the 10-year yield has been seeing some significant strength. Even if you go back to this low right here and you bring the line up, it brings you up right to and around here. And when the 10-year yield, what happened? When it started shooting off, guess what was affected? The housing index. So one can assume if the 10-year yield is going to start to stall out or fall over, this could very well benefit for a bounce, a short-term bounce, maybe a longer-term bounce in things like the housing index. You can see over here when the 10-year yield was falling, right? Housing was moving up. Okay, let's look at something other than just those assets. Let's look at the 11 sectors that make up the S&P 500. I'm showing 10 of the sectors. XLRE, it didn't fit on my screen. Okay, XLRE is a deep negative correlation. Just know that across the board there. So here's the dollar correlation. So the dollar is up here. Then you have XLK, XLY, XLC. That's, down the list, XLI, XLE. And what I'm showing you here is that technology has a pretty negative correlation at 0.75. XLY, which is consumer discretionary. And remember, a few names, names, equities make up these sectors for the most part, but deep correlated negative correlation there, 0.88. XLC, communications, minus 8.6, another deep correlation. Okay. XLI, also pretty deep correlation. XLP, look at that thing. That thing is flat as a pancake, a minus 0.91 negatively correlated state to the dollar. This is some big news here. I'm going to follow back up on that and so forth down the list. You got financials, utilities, not crazy deep by any means. So that's kind of just there. But there you see two that are rising correlations, right? Two rising correlations that are positive, and that's energy is positively correlated to the dollar right now. And you have healthcare positively correlated to the dollar now. So what does that mean? If the dollar is going to start backing off, you might want to look to basically get out of some healthcare names because they may fade. Now, there's not a strong positive correlation. It's close to no correlation, but that is just something to note. Energy's been moving up with the dollar, and healthcare has been moving up with the dollar. What about the 10-year yield? Look at the 10-year yield. Same situation. You have energy rising with the 10-year yield. That makes sense to me, right? Because we talk about how the oil really kind of leads the way. Then you have bonds that typically follow or yields that follow. So energy has a strong correlation to oil. So it's normal to see this. And that's what you're seeing right here. Then you have deep negative correlations for the most part across the board in every other sector. The strongest negative correlation in this right here is 0.94, negative 0.94. And that's in consumer staples. In fact, it's most of the time in a negatively correlated state. Now that is important to me. Why? Because we're seeing energy up there, right? And then we're seeing consumer staples more towards the bottom of the list. And I look at this and it makes me think, right? This is the 11 sectors that make up the S&P 500. And you got the orange, which is the stock market cycle. You have the blue, which is the economic cycle. And sometimes you go through these, in even smaller fractal moves, like so forth. This is, a cycle's rotation. But sometimes what I've seen here is you'll go through strength and energy. It'll go quickly through these, and then it'll come back to tech and discretionary and so forth. So what I find interesting here is you have energy up here, and it's one of the top performers from a year-to-date perspective. It's actually up 4.5% year-to-date. Now, come on, it's the 13th. It's still early, right? It's clearly really early. Healthcare is right there by it too. All right, standing right by each other. So, surprise, surprise. But then consumer staples, this is where it gets weird to me. Consumer staples is the worst performing sector. Now, this I find to be interesting because if we're going to move through this cycle here and kind of go through this list, and we might not, but consumer staples could be an opportunity this year, or in the shorter term, if we're going to see a potential change, as we've stated, in the dollar and the 10-year yield. So if I pull up this chart and we look at consumer staples and the dollar, just take a look. I mean, you can see right here, the dollar started firing off like a rocket ship. What happened to consumer staples? Bam, it got hit. It got smoked. And the same thing is if you bring up a 10-year yield chart, it's going to look just like that. Okay, what about over here when the consumer staples started doing really good in 2024? Well, what was the dollar doing? I mean, it was going down, right? Choppy and down. So that could be, it could indicate that a stronger dollar, we're exporting inflation, right? Because some of these consumer staples, they do business worldwide. And the more higher the dollar, the more expensive it is for foreign buyers. And if you look here, what are the top holdings within the XLP? You got Costco, Walmart, Procter & Gamble, Coca-Cola, right? Pepsi down the list. So you have some names that are clearly international brands. And if I bring up a correlated chart for 20 days where I put, the dollar here and then correlate the dollar to those various assets, Costco, Walmart, Procter & Gamble, Coca-Cola, PepsiCo, Philip Morris, Alitura, I think that is, CL, is that Colgate? No, I'm forgetting that one. And Mondelez, MDLZ. What is CL? CL is, Colgate. Okay, cool. Yeah, I got it. And look they're all pretty deeply negative, right? So if we're going to start to see a turn in the dollar, some of these names have been smoked, absolutely smoked. And the reason why I'm saying this now is because typically, right, like we said a while ago, during the Trump administration, the last time into 2017, the dollar was weakening. Now, I'm not saying that that's going to be the same situation, but if it is, you can very well see some of these consumer staples, which are lower beta but pay a high dividend, they could benefit. It could benefit to not go full bore into consumer staples, but it could benefit to have some names potentially in the portfolio alongside maybe some of the other names that might find relief in the near term, like, for example, things that are in the SPY or the NASDAQ 100, right? Or in some other various small caps. So I find these correlations to be just incredibly interesting right now. Now, remember, correlations change over time. I'm showing you what they are right now, okay? I want people to understand that. Now, if we just look at the asset itself in the absolute terms, it's the 10-year yield as it stands right now. It's stronger than heck, right? We still have a negative divergence actually on the price momentum oscillator, but it's still in a bullish trend here. So very strong, but we are getting a little bit frothy. If this thing, watch for potentially 5%. That'd be crazy to think, and I think it could put more pressure on the markets. But right now, things are getting frothy. Things are heating up. Inauguration is coming on the 20th. We'll see if any, for example, the macro reports that are coming out could very well change how this looks, right? It could make it far worse, go way up higher, or it can change the trajectory by our next inflation data until the next one, right? If you look at TLT, the TLT has obviously been sinking off over here, and we're coming down into some prior levels that we've once bounced from before. This is, not unadjusted here, but it's still relevant, right? We've used this diamond pattern before to measure out a move to around 95. Medit came all the way down. And now when you think about it, I mean, this is TLT, right? It could be presenting itself really a generational type opportunity, because if you unadjust this and you look back through history, I mean, it hasn't been this low for a very, 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 very long time. And that means that the dividend yield is rather high, right? It's over 4%. So if we do start building positions and it comes down further, right? And, what are they going to do to potentially save the bond market? And if you can build a position and you can get that 4% and potentially the appreciation of the asset, that could be a win-win situation for something like TLT. It's just in a very precarious place, obviously, right now. And then you have the dollar. The dollar has obviously been seeing strength since October, straight up. Perhaps the market's trying to front run what the president is already going to do, or the president-elect is already going to do, when that could have to do with tariffs. So when they actually come out or you get more news around it, it could potentially be a sell the news event. The market is a discounting mechanism. Now that's just a narrative, but what is the dollar doing right now? It's going straight up. We do have a negative divergence here as well on the price momentum oscillator, but we're still in a bullish trend there as well. As we previously stated, the dollar is getting a bit frothy towards the higher end of these bands. Okay, let's hop into some signal charts, see what's cooking good looking over there, and then we'll get into expected moves and market conditions. I'm going to look at some of the bullish percent charts if you don't know what these are. Really quickly, it's giving us a reading of the percent of stocks on buy signals based off of the tic-tac-toe charts, right? Point and figure charts. Right now, it's at 45.17. I'm looking at the NASDAQ Composite Bullish Percent Index. I like to apply an RSI, and I like to look for divergences. We have a lower low on the chart. We have a higher low currently on the reading. So a bullish divergence is once again forming on the NASDAQ Composite Bullish Percent Index. The NYSE also, it's dipping off into some low territory that we haven't seen since November of 2023. And we have a positive divergence currently in the works in the NYSE Bullish Percent Index. For the Dow Jones Industrial Average, also bullish divergence forming as the price action comes down. So we have a bullish divergence forming there. Bullish percent index for the SPX. Hello, we got a bullish divergence there. We have a low and a much higher low as it stands in this current moment. It's not that extendedly low of a reading. However, it's getting down there to levels that we haven't really seen since, well, November of 2023, which keep that in mind because I'm going to be showing you an interesting chart on November 2023. Okay, the percent of stocks above the 50-day moving average and the 200-day moving average for the NASDAQ 100, that's been dropping off, right? And it's getting pretty frothy to the downside. Right now, only 19% of the stocks in the NASDAQ 100 are above their 50-day moving average. And if you look to the left of the screen, typically when you get down into these lower levels, you could produce bounces and find bottoms. You can look a little bit further and we reach down to and around the 10% marker. And this is what I really like to see over here on very extended readings in correlation or in confluence, with the 200-day also falling off. You can see the 200-day we're still holding a lot of the 200-day moving averages as it stands right now. 55% of the stocks are above it. So we're floating around 50%, which is still relatively low, but you can see that we are still holding it. But what I like here is you see a low and a higher low where price action went lower on the NASDAQ. And that right there was telling us there's more stocks internally that are getting stronger while the index is getting weaker. And that can spark moves, counter trend moves. Okay, look at the bullish percent. Sorry, not the bullish percent. The percent of stocks above the 50-day for the S&P 500 and the S&P for the 50. Oh my gosh. The percent of stocks above the 50-day moving average in the S&P 500 and the percent of stocks above the 200-day, you can see that this is cracking new lows. This one cracked new lows. In fact, 19% of the stocks, 19.6, are above their 50-day moving average, 54 above their 200-day moving average. And this is actually moving in, it's correlated to the market right now. So the market put in new lows. This did too as well. Now, this is the percent of stocks above the 20-day moving average across multiple assets. S&P 500, S&P 600, 400, so small cap, mid caps, all of it, 1500, S&P 100, right? Dow Jones, NASDAQ, NYSE, NASDAQ, and really nothing's in an incredibly oversold condition, but what I'm calling out is these lows that have been picking up. So we're seeing us coming off extended areas, but while we're coming off extended areas, like right here, right? So this is the S&P 500% of stocks above the 20-day moving average. So 28% of the stocks, we got oversold. We put in a higher low, and over here, we put in a low and a lower low. What does that mean? It means in the very short term, we have internals that are strengthening, but the market is pressing lower. The last time this happened, ding, 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 was back in November of 2023. So that's why I wanted you to remember that. So you have a low, a higher low. The market saw volatility, put in a brand new low in November after a 10% correction there, right? And then we started to find ourselves some foot. Now, does this mean the same thing happens? No, that's not what it means. But in the very short term, for this small little moving average on a 20-day basis, it is showing some internal strength. If we look at back month versus front month volatility, I like to wait to see if it comes down to 1.0. And or when it gets to 1.2, which is 20%, this can give us overbought areas and oversold conditions. Right now, we're kind of just floating around here, which means that we probably still have some more room to go down there, but we're kind of floating in no man's land, so it's not giving me much at this moment. If we look at the 5, 10, 20 timer, which is applying those EMAs, you can see that we're in a bearish trend. We have the 5 below the 10, which is below the 20. They're all trending down. In fact, they crossed over and through each other right here and back through here again. And you can see we have volatility. The last time that happened was really over here where we saw, a similar situation until we started to recoup. We saw a little bit kind of happen here until we started to recoup there. And the same thing here. So I like to look at this. You want them trending all in the right direction like this, because then it just confirms a stronger trend. So right now it's confirming a strong trend, but it happens to be more of a bearish trend. I want to update you on the Sailor to Shift tool. The Sailor to Shift tool did give us a sell signal about 2 weeks ago or so, and we haven't really gone anywhere from that sell signal. I think this was the confirmation of the signal right here, and we're basically right at those levels, maybe a little bit higher right now. And we're starting currently on today's candle wick is helping us get the the rate of change between Bitcoin and gold to go more towards the positive area. We want to close above the zero line to give us the signal. It's just not there yet. However, we are just kind of consolidating. We're on a sell signal, sell trigger, and I'll bring this back up when we get a buy signal, buy trigger. It's as easy as that. Now, I'll just tell you, sometimes people like to play the turns. Like, for example, some people I know, when they started to see this turn down, they're like, yeah, probably not the greatest time. And guess what? It went down. Some people might look at this and be like, yeah, I'm going to be getting in here. And they might be right. However, I always just wait for confirmations to put the signals on the chart, but that doesn't mean you can't trade from an absolute basis either, right? This is not the holy grail. It's just something has helped and worked. It's caught in every big sell-off, and it's caught in the bulk of all the big run-ups there too as well. All right, let's get into some expected moves. I want to start with the weekly expected move for the SPY. This week, we're looking at $11.74. That's plus or minus. Today, we basically closed unchanged. We started lower, we closed higher. This is technically a bullish reversal candle. It would have been more bullish if we pierced through, about 50% of the prior candle. Call it a piercing pattern that would be called a piercing pattern. So it's still bullish, but it has to prove itself. It's basically unchanged in all honesty. Okay, now the weekly expected move is plus or minus 11. That's because of the inflation data. That's because we have some earnings kicking off. We have not seen an expected move this big since the election results week, right? That was a $15 expected move, and we closed well outside of it when the election results came in. So since that point, we did what today? We came in, we closed the gap on that specific day. So this entire consolidation area, right, be it the head and shoulders, be it whatever you want to call it, this is the term that I just called the inauguration consolidation. So perhaps when he's in office, right, and we understand kind of more about risks that may be coming into play, rewards, whatever the case may be, then we might get a break from this larger consolidation pattern that we're currently experiencing. Going into tomorrow's trading session, we do have PPI data, and we have a large expected move for the SPY. It's roughly $4 plus some change. The upper levels, the zone would be up here. The lower levels would be down here. Screenshot it and put them on your screen. Right now, we are below a 5-day moving average that's declining. We're below a year-to-date anchored volume weighted average price that's declining. And we're below the year close, meaning we're negative on the year. So if we come up into these areas, which is very likely setting up for some sort of a trend day, just be very mindful that there's a lot of resistance up in this area that we have to break through. Right now, we've been seeing a series of lower highs and lower lows. And what you really want to see is that to change. You want to see, well, maybe this was its first higher low, right? Then maybe this in the very shorter term, but you want to start breaking from that type of a trend. You can see here, if I were to just draw this line across, you can see that we're kind of coming into this trend line, and I'm seeing some strength in the aftermarket. I don't know what's going to happen, come tomorrow morning, but I'm seeing some strength in names like Tesla today, which I do have a position in. I'm not going to get too much into that. I posted a lot of that in the trade ideas stuff, and and so forth. If you want to see that, just hop in the Patreon. It's $9, or go to my Twitter and I'll post some charts there. Okay. So those would be the levels. This is the upper for the weekly, lower for the weekly. Remember, 75% of the time to 80% of the time, we tag these weekly expected moves. It's very common to do so. And we have a wide open range still right now. Market conditions. So things look like we can potentially pop, but there's still a lot of uncertainty, and the conditions of the market are still dangerous, right? From a bullish perspective and a bearish perspective, trust me, because if you're bearish right now, you can get your face ripped off. And if you're bullish, you can wake up, with the market down like we did today and, freak out, right? If you freaked out, by the way, and you don't know the daily expected moves, if you started down here and you were all like, no, and you got out and we closed up here, you might be chasing it up here. And then all of a sudden we start back to the day lower. This market is wild, and that's what happens when you're in negative gamma. So if we look at a net gamma chart, you got 6,000 over here as, the current call wall. It's floating around 6,000, 6,100. It's flowing back and forth. I keep on seeing these spikes. Then 5,800 is the put wall. And then right here is 5,700. So if we start breaking from 5,800, look 50 points lower, and then another 50 points lower after that. But right now, we're getting pinned around that 5,800. So if I draw that on my chart, you can see this. There's 5,800. Here's 6,000. We're kind of in that range, and we've been doodling around in this kind of range. The gamma flip line is right here at about 59.30. We'll see what that looks like in the morning, but right now it's about 59.30. And this gamma flip line tells us how market dealers really are going to operate when we're below it and above it. When we're below the flip line, you get selling into selling, you get buying into buying. I've shown the chart on the last video. Volatility increases, right? And when we get back into positive gamma territory, look to buy the dip and sell the rip, volatility will decrease. So it's a much better environment for swing traders here above the flip line, and below it, it's typically much better for day traders that love that intraday volatility where you get that two-sided trade. The next thing I look at is the direction of the 5-day moving average. If we look at this right now, SPY, Q, IWM, Dow Jones, semiconductors, XBI, they're all red, meaning what? It means that it's below a 5-day moving average. The 5-day moving average is currently declining. So are you going to sit here and try to use all your efforts to fix this, or are you going to wait for the market to prove itself to potentially join that trend? That is ultimately up to you, but we could see the trend change very quickly. We can be right back up here. Boom, start to consolidate, 5-day moving average starts to turn around and sets up new opportunities for this year and for this new presidency. So that's all I got for you on today's episode, everybody. Hope it helps out, gives you some interesting insights to this market. See you later.